Imagine an evening in New York in the late 1940s. A successful businessman walks into an upscale restaurant for dinner with his business partners. When the bill arrives, he suddenly realizes he left his wallet at home. He has no choice but to call his wife and ask her to bring money to save the situation. At the same time, in middle-class homes across America, if families wanted to own a Frigidaire refrigerator or a new Ford car, they usually had to sign long-term installment contracts or record the debt in the local store's ledger book. That was America, the symbol of consumer capitalism and the American dream, and yet, at that time, there was still no universal credit card in the modern sense. The old world operated quite effectively in its own way. Before the major turning point, consumer credit already existed, but it was fragmented and deliberately designed installment plans for cars, furniture, and sewing machines. Store credit accounts with thin metal charge plates, layaway deposit plans, or personal loans from specialized finance companies and credit unions. Thanks to this system, millions of Americans were able to own cars through GMAC, starting in 1919 Singer sewing machines from the mid-19th century, and even homes after the reforms of the New Deal era. This was absolutely not a time of credit shortage, but a system intentionally built in the aftermath of the horrific collapses of the Great Depression. So how did ordinary Americans buy expensive items before the universal credit card existed? What philosophy and intentions did lawmakers and policymakers embed into the old credit system after the banking disasters and mountain of debt? Why exactly in 1950 did the turning point occur, forever changing the relationship between citizens, banks, and the state? This story goes far beyond the convenience of a small piece of plastic. It is a deep and prolonged conflict between two opposing visions of America. One side is the New Deal philosophy, which emphasized stability, tight control over financial power to prevent banks from using people's deposits for risky speculation, protection of borrowers from debt traps, and directing credit mainly toward production rather than reckless consumption. The other side is the desire for personal freedom in spending the democratization of credit access and viewing debt as a powerful tool to drive broad-based economic growth. That tension still haunts us today through heated debates about student debt, the housing crisis, and how banks should be regulated. Credit and currency have never been neutral tools. They have always been the product of institutional designs deeply shaped by politics. The fact that America had to wait until 1950 for the birth of the Diners Club was no accident. It was the result of a complex historical bargain between the fear of repeating the 1929 disaster and the intense desire for post-war consumer prosperity. To understand why Americans had to wait until then for the first universal credit card, we need to turn back the clock to the time when an entire nation was forced to completely redesign its credit system from the ruins of the Great Depression. Dear friends, if you enjoy diving deep into these instructive financial history stories, please give this video a like and subscribe to the Financial State Secrets channel right now so you do not miss the next episodes. Together, we will explore this dramatic journey. From the ruins of the Great Depression, America was forced to rise and rebuild its entire credit foundation. Picture the context at that time. From the late 19th to the early 20th century, the country transformed powerfully from a traditional rural society into a vibrant urban industrial nation. Consumer credit at first was personal and scattered mainly based on trust between local sellers and buyers. By the 1920s, the wave of industrialization changed everything. Installment contracts quickly became the key tool enabling the middle class to access Ford Model T cars through GMAC from 1919, as well as modern radios, refrigerators, and furniture. By 1929, consumer credit was financing the majority of durable goods sales. However, the easy availability of credit when combined with the stock market speculation frenzy pushed the economy into the abyss. Thousands of banks collapsed, with more than 9,000 banks failing between 1,930 and 1,933. Millions of families lost their homes because of risky short-term mortgages, terms of only 3 to 5 years with a large lump sum payment due at the end and requiring down payments as high as 30 to 50%. The homeownership rate plunged, hitting a low of about 43.6% in 1940. Faced with that pain, leaders acted decisively. President Franklin D. Roosevelt, along with Senator Carter Glass and Henry Steagall, were the chief architects. They deeply believed that personal freedom in spending could not be left completely unchecked, but needed to be bound by collective rules to protect the system itself and the people. The Glass-Steagall Act of 1933 clearly separated commercial banks, which took deposits and made safe short-term loans from investment banks that specialized in risky activities. This was a deliberate decision to limit enormous financial power and protect people's savings. Along with it, the Federal Deposit Insurance Corporation, or FDIC, was created, providing a solid safety net for depositors. The core philosophy was crystal clear. Banks must not be allowed to use the public's deposits for speculative gambling. Credit must serve real production and long-term stability rather than fueling wasteful consumption. The new system was built with specific and strict mechanisms. Installment contracts had fixed terms, required high down payments, included hidden interest or heavy late fees, and allowed easy repossession of assets. Store or gas station credit accounts used thin metal charge plates but were limited to a single merchant's ecosystem and usually required full payment each month. Before the New Deal, home mortgages were high risk with short terms. Afterward, the Homeowners Loan Corporation, or HOLC, in 1933, rescued many distressed loans. By 1934, the National Housing Act established the Federal Housing Administration, or FHA, which ensured long-term mortgages of 20 to 30 years with automatic gradual amortization and significantly lower down payments. This was truly a revolutionary step forward, yet initially it was distinctly discriminatory. Policies strongly favored newly built white suburbs. While only about 2% of total FHA loans from 1934 to 1962 went to black communities, a reality known as redlining that left a deep mark of lasting inequality. For personal loans, most relied on specialized finance companies with higher interest rates, or credit unions supported by federal law in 1934. Commercial banks were strictly restricted from consumer lending to minimize systemic risk. This system was the living embodiment of restrained liberalism. The state actively intervened deeply to protect society from the brutal fluctuations of pure free markets. Thanks to it, America achieved relative stability and gradual recovery. However, that design also left important gaps and inherent shortcomings, especially rigidity and unequal access. A big question gradually emerged: could these controls be loosened without awakening the old nightmare of 1929? And then how did this system operate at its peak? Why did it begin to lose the ability to meet the needs of an America that was changing rapidly after World War II? We will explore that right away. Even though it was born from pain and caution, that credit system proved remarkably resilient and capable of supporting real economic growth. Picture its golden years. Installment contracts became the main engine driving durable goods sales, from cars, refrigerators, and radios to household furniture. Companies like GMAC and other automakers provided direct financing, allowing buyers to own assets without needing the full amount up front. The layaway plan was very popular, especially during major holidays like Christmas, when families could receive the desired gift right after completing the payments. Thin metal charge plates at stores allowed regular customers to shop without carrying cash every time they visited. Meanwhile, credit unions and small loan companies filled the gaps for those with more modest incomes. The entire system operated with high transaction costs because each deal required individual negotiation, but in return, risk was reasonably dispersed. Credit evaluation relied mainly on long-standing personal relationships or clear collateral, creating a safer network compared to the previous chaos. Let me tell you a few typical stories to clearly illustrate both its strengths and limitations. A working-class family in the mid-1920s could save up for a down payment to buy a Ford Model T on installments. They made steady monthly payments from their hard-earned wages. However, if an unexpected unemployment hit the car, their most valuable asset immediately risked being repossessed. Or in 1933, while the crisis still lingered, many families lost their homes simply because they could not manage the large final balloon payment on their mortgage contracts. Those tragedies remind us that despite the legal protections, the system was still rigid. During World War II, the government tightened consumer credit regulations even further through Regulation W, prioritizing resources for weapons production and curbing inflation. This clearly showed the state's willingness to intervene forcefully and temporarily restrict people's spending freedom when national interests demanded it. Looking more broadly, the old system delivered major benefits. It strongly promoted the growth of the automobile industry and durable goods sector. After the New Deal reforms, the combination of FHA programs and VA loans from the GI Bill of 1944 opened the door for millions of veterans and their families to access housing under more stable and safer borrowing terms. As a result, the national homeownership rate increased significantly, helping to strengthen the middle class and laying a solid foundation for economic recovery. Moreover, this mechanism effectively protected people's deposits and substantially limited risky speculative activities. However, beneath that layer of stability, deep limitations still existed. Access to credit was unequal. Women, Black Americans, and low-income households often faced much greater barriers. Policies favoring white suburban areas unintentionally deepened the wealth gap between communities, a legacy that still affects society today. Real interest rates in some lending channels were quite high. While the transaction process remained cumbersome and lacked flexibility for everyday spending needs or travel, in particular, the system had no flexible revolving credit mechanism. Every debt was a fixed commitment, not a smart tool for managing cash flow. And the hidden dark side was even more concerning. During an economic downturn, waves of asset repossessions and home foreclosures could quickly worsen the crisis, just as happened in the late 1920s. That system provided a solid foundation, but cracks were gradually appearing inside it that were hard to heal. After the war, the country entered an era of prosperity far beyond anything previously imagined. Average incomes rose rapidly, and the population exploded with the post-war baby boom generation. Suburbs sprang up like mushrooms, with Levittown as the prime example. Rows of mass-produced homes that became symbols of the new dream. Television entered every household. bringing colorful advertisements that celebrated the modern lifestyle, a TV in the living room, automatic washing machines, larger refrigerators, and even a second car for the family. Young families no longer wanted to wait years to accumulate savings. They craved immediate ownership so they could enjoy the fruits of peacetime. The traditional installment system with its fixed commitments and clear terms became too rigid for that fast-paced life. Businessmen who traveled frequently between cities needed a much more convenient payment method than carrying cash or checks, especially when transactions occurred in many different places. Some banks and stores tried to improve the situation by experimenting with local credit forms in the post-war years, but those efforts remained fragmented, lacking scale and widespread impact. Credit unions continued to grow, yet their scope of operations stayed limited and insufficient to meet the broad needs of society. No breakthrough solution was strong enough to change the overall picture. Deep down, sharp conflicts of interest existed. Commercial banks remained bound by strict regulations while specialized finance companies dominated the consumer credit field. Consumers and merchants desired convenience and faster sales, but many still worried about mounting debt and the erosion of traditional saving ethics. On the political level, during President Eisenhower's time, the trend of loosening controls gradually replaced the tight stability of the previous period. Pressure from the industrial sector and the banking community for expanding the consumer market grew increasingly strong. Class and regional contradictions also became clear. The old system often strongly favored the white middle class in the suburbs while leaving large gaps for other groups. This was essentially a profound confrontation between two different versions of American capitalism. The earlier version viewed debt as a tool that needed tight control to protect society's overall stability. The new version saw debt as a powerful engine for economic growth and a symbol of personal freedom in an era of prosperity. The key question still hung in the air: could loosening those constraints happen without reawakening the catastrophic risks that had occurred before? And then, that moment finally arrived. Imagine an evening at Major's Cabin Grill restaurant in New York. Frank McNamara, a dynamic businessman, was having dinner with his partners. When the bill arrived, he suddenly realized he had left his wallet at home. That story, although sometimes retold as the legend called the First Supper, became a powerful symbol for the birth of a history-changing idea. Together with Ralph Schneider and Alfred Bloomingdale, he quickly turned personal frustration into action. They founded Diners Club, the first universal payment card not tied to any single store. At the beginning, the card was only accepted at 27 restaurants in New York City. Made from stiff paper material, the card required the cardholder to pay the full balance every month. Members had to pay a $5 annual fee, while merchants paid a commission of 7 to 10%. Though modest at launch, Diners Club quickly expanded into hotels, airlines, and many other types of services. The context at the time was extremely favorable. The post-war economy was booming, and demand for travel and spending on entertainment and business services surged. The Diners Club card directly solved the difficulties faced by traveling businessmen. They no longer had to carry large amounts of cash or checks when working far from home. This was a pure market-driven innovation not originating from government policy. However, it cleverly built upon the stable foundation created by previous reforms, a safer banking system, and restored public confidence. There was no shortage of concerns that this would encourage excessive spending. The founders cleverly responded by emphasizing that it was only a convenient solution, not easy lending. The deeper reason for Diners Club's success lay in the large gap left by the old system. Traditional installment contracts were too rigid and lacked flexibility for the new consumer lifestyle that was emerging. This innovation quickly spread among businessmen, delivering real convenience. Then, in 1958, a bigger leap occurred when Bank of America launched Bank AmeriCard in Fresno, California. This was the first universal bank card that allowed true revolving credit card holders could carry a balance, make minimum payments, and pay interest only on the remaining amount. The Fresno Drop campaign on the 18th of September 1958 mailed 6,000 cards to local residents without prior applications, along with immediate credit limits. This model quickly spread, creating a genuine revolution. Credit was no longer just a tool for fixed installment purchases, but became a means for daily cash flow management for millions of people. Diners Club and Bank AmeriCard were not merely new financial products. They marked a clear shift in power from the state's controlling role to the creativity and expansion of the market. This was the pivotal moment when the desire for personal freedom and spending began to prevail over the previous philosophy that prioritized stability. Diners Club and Bank AmeriCard were only the beginning. The long-term consequences of this revolution completely transformed America and left complex legacies that continue to this day. Diners Club and Bank AmeriCard were just the first seeds. From there, an entire new system quickly spread and reshaped the whole economy. The scale of consumer credit surged after the turning point, rising from low levels during the war to tens of billions of dollars within just one decade. Banks were no longer as tightly constrained as before. They actively issued cards and profited from interest on unpaid balances and interchange fees. The government also adjusted its role accordingly. Once the gatekeeper protecting the public from banking risks, the state gradually became an enabler of broader credit access while still intervening to correct abuses. The Truth in Lending Act of 1968 required clear disclosure of real interest rates and important terms. By 1974, the Equal Credit Opportunity Act banned discrimination and expanded access for more groups. The journey continued with key milestones. In the same year of 1958, American Express also launched its card. In 1966, MasterCharge, later known as MasterCard, appeared. The 1970s and 1980s saw the deregulation of interest rates. By the 1990s, rewards cards with points and benefits exploded in popularity, but that success also brought risks. By the 2008 crisis, household debt reached record highs, and the process of turning debt into securities created a collapse far larger than what occurred in the late 1920s. To truly understand the nature of this change, we must look directly at the differences between the two systems. The old system was fragmented with high cost per transaction. Credit evaluation relied on personal relationships and tangible collateral. It kept risk at a manageable level and encouraged borrowers to take clear responsibility for each debt. As a result, the economy maintained relative stability and avoided deep debt spirals. However, it also limited the number of people who could access credit, involved slow processes, lacked flexibility, and featured clear inequalities in opportunity distribution. The outcome was solid industrial growth, but the spread of mass consumer culture was held back. In contrast, the new system became more universal than ever. Revolving credit offered high flexibility, combined with data and credit scores for risk assessment. Initial barriers were lower, but interest rates could rise sharply if balances were carried. Its standout advantage was superior convenience, which democratized spending and drove unprecedented consumer growth. Yet the drawbacks were also clear. It easily led to prolonged debt, created new forms of inequality, as lower-income people often bore higher interest costs, and allowed risk to spread from individuals to the entire financial system. The broad social impact is undeniable. We shifted from a culture of save to own to a model of use debt to enjoy modern life. Financial power became heavily concentrated in the hands of large institutions. Citizens became more dependent on credit to realize the American dream, from homes and vehicles to education and healthcare. Personal freedom to choose spending increased significantly, but financial autonomy declined as debt became an inseparable part of everyday life. This shift was a complex trade-off, both intentional and inevitable. It balanced the desire for growth with the need for stability, and the expansion of opportunity with the danger of hidden risks. The state first protected citizens from excessive banking power, then supported market expansion, and finally had to step in to manage the resulting consequences. So what have we learned from this entire journey? The history of American credit is not just a story about convenience. It is a story about power, values, and the kind of society we choose to become. Through each stage, we see clearly that credit and currency have never been neutral tools. They have always been the result of institutional designs deeply colored by politics. The initial system was born from the trauma following a major disaster, with the goal of limiting financial power to protect overall stability and basic fairness in society. The later system reflected a powerful desire for growth and everyday convenience, but at the same time opened new risks of debt gaps and systemic instability. The greatest lesson is that every major change in the financial field requires clear value choices between the need for long-term stability and the drive for development, between protecting the people and granting individual freedom, and between expanding access to opportunity and the danger of abuse. We need to view this transformation in a balanced way. Diners Club and Bank AmeriCard brought conveniences and opportunities that previous generations could not have imagined. They helped countless families build more modern lives with better homes, improved transportation, and access to a wide variety of goods. However, these very innovations also help nurture a culture dependent on debt, leaving many people today feeling trapped in a cycle of credit card debt, student debt, and mortgage debt. This is not purely a story of progress, nor is it simple decline. It is a profound shift in power and societal priorities. Today, the echoes of that journey still resonate in countless contemporary debates. From the massive issue of student debt banking reforms after the Great Financial Crisis, to the regulation of emerging financial technologies, and even buy now, pay later plans, all revolve around the same core question: how can credit become easily accessible without turning into a debt trap and a threat to the entire system? How do we strike a harmonious balance between each individual's freedom of choice and the responsibility to protect the common good of the community? The history of credit in America reminds us of a profound truth. The most powerful financial tools do not merely determine how we shop every day, they also shape the kind of citizens and the kind of society we become. Understanding the origins and true nature of the current system is the first important step for us to demand a fairer and more sustainable model for future generations. Money and credit are power. The question is not whether we use them, but who holds control over them and for what purposes they are used. Thank you for joining this journey of discovery. If these in-depth analyses of history and contemporary lessons have given you something to reflect on, please give the video a like and subscribe to the channel to continue receiving many more meaningful stories. Together, let us understand the past to build a brighter future.